Welcome to Yahoo Finance Live. I'm Julie Hyman. That's Josh Lipton. We're here at the New York Stock Exchange. Happy Friday, everyone. We've got the big three at 3, the 3 things you need to know at 3 p.m. Eastern. We start with markets on edge after the 10-year Treasury yield hit 5%. It didn't stay there, but still it was the first time it happened since 2007. And now it's raising fresh concerns about the economy and the Fed's next move. The tech-heavy Nasdaq, the worst performer of the three major averages, as key names including NVIDIA and Tesla are on track for their worst weeks of the year. We're going to be tracking all the market action.
And House Republicans back at square one. Congressman Jim Jordan is no longer the nominee to be House Speaker after he failed a third vote to secure the gavel. Chaos on Capitol Hill coming as President Biden formally requests over $100 billion in aid for Ukraine, Israel, and the southern border. Eurasia Group President Ian Bremmer weighs in later this hour.
Plus, new developments in the UAW strike. UAW President Shawn Fain set to speak next hour, and it comes after General Motors raised its offer to the union. We'll have a look at whether there may be a resolution in sight as the strike stretches past the 1-month mark. Let's get you up to speed right now on the market action here. An hour to go in the trading session on this Friday, and we have all three major averages in the red, as we mentioned. The Nasdaq leading declines off by 1.2% or so, and we also have the S&P 500 down by 0.9%. The Dow off by about 0.6% right now. And it looks like, as we talked about, it is technology that is helping lead the declines here.
So let's look at what's moving the markets today. As you mentioned, Julie, stocks following the SPX, the S&P 500, headed for its fourth straight drop here. Folks pointing out that it did briefly cross its 200-day moving average, so long-term trend line traders watch closely. Got to talk about Treasuries as well, but the yield relief today, right now, 10-year looks like it's around 4.929, but as you mentioned, we did briefly cross 5% yesterday, and of course we watched that because that is a key benchmark for borrowing costs, everything from mortgages to corporate loans, you name it. We did get some Fed speak today. We want to touch on, of course, we got some Fed speak. They love talking.
Well, the blackout period's about to begin, so then we won't hear from them as much. But they've been piling it in.
Get it all in. Get it all in beforehand.
Exactly.
So today, this one, though, thankfully, was actually interesting, I thought, because it kind of broke away from the pack. So today was Cleveland Fed President Loretta Mester, now a non-voting member, but said today she still sees the possibility of one more rate hike this year. This is consistent, she said, with my own reading of economic conditions, the outlook, the risk to the outlook. That's what she said in a speech here in New York. Still, she views inflation risk to the upside, she says, and she pointed to, of course, those higher oil prices, which we've been talking a lot here about. And of course, folks are looking at that now as a kind of gauge on whether this is real Hamas war spills over. She said the CPI report for September is a reminder that we cannot count on the progress continuing at the same good pace we have seen in recent months. So interesting, because the drumbeat has been from a lot of our policymakers, we've done a lot.
Right.
We've done a lot here. We've moved fast, and maybe we can pause, take a breather. And Loretta Mester is at least giving some different context here, saying things a bit differently.
It seems to me that Jay Powell yesterday in his comments left the door open as well. What's interesting today is even if we're getting relief on bonds now, they hit 5%.
Yep.
So maybe that was a reminder to the markets that the 10-year could, it's happened now. And even though we're seeing relief now on bond yields in today's session, we're not getting relief on the stock side, which is kind of interesting. And a couple of things to note along with that. We've had this volatility in the bond market. That's something that Mohamed El-Arian flagged in my conversation with him yesterday. He talked about the lack of stability that we are seeing, the lack of anchors in the bond market right now. And even as we are seeing those yields come down, volatility in stocks is still remaining elevated. If you look at the VIX, yesterday it went above 20, and it is remaining above 20 today, which again reflects hedging activity, volatility in the market. The so-called fear index is at an elevated level. Something else that I'm watching here is the effect that these higher yields, again, even though they're lower today, but in general, the upward trajectory in yields is continuing to have on technology stocks in particular. And one of the measures of that is exemplified in a chart that was flagged by Bloomberg. And it echoes something that Mike Darda told us recently. He talked about the earnings yield of companies in the major averages, and particularly tech companies. The earnings yield is just the PE flipped. It's instead of price divided by earnings, it's earnings divided by price. And if you compare that earnings yield with the U.S. Treasury yield spread, basically Apple is getting less attractive on a yield perspective versus what we're seeing in the Treasury market as we see yields go higher. So that's one of the reasons why we could be seeing some selling as well in some of those tech names, and why you see that relationship between the Treasury yield and how these stocks trade.
Yeah, when Darda speaks, I tend to listen. Smart guy.
Yes.
And interesting, when we talked to him in the equity market, he was defensive. Utilities guy now.
Yes,
yep.
Exactly. And he's not alone at the moment. Let's talk more about the big picture context here for the moves in the bond market and the ripple effect throughout markets. Lisa Erickson joining us now, U.S. Bank, head of the Public Markets Group. Lisa, thank you so much for being here. It's good to see you. I know we're not at 5% right now, but obviously we touched 5%. What does a 5% 10-year yield mean for U.S. equities?
Well, certainly 5% is a psychologically important number because it really represents another level to which the rates have moved, not only, of course, on the short end because of Fed hikes, but also as being reflected by market participants in some of the longer sectors that, to your point, can really impact some of the other borrowing costs throughout the economy. And so I think what we're really just seeing with the last few market moves in the stock area, that really investors are just becoming more aware and cognizant of that higher for longer mantra, not just with what's going on with the Fed, but again, how market is pricing that out on the long end.
And Lisa, I'm interested to get your take on what you made of Fed Chief Jay Powell's comments yesterday. Did you find them hawkish or dovish? I mean, he seemed to have a bit of something for everyone there.
Well put, Josh. We really saw it as both sides of the coin. He certainly recognized the fact that because longer term interest rates are also moving up, that could be a consideration in terms of where the Fed moves its policy and potentially give them a little reason to be a little bit more cautious in further hikes. But on the same time, he made it very clear that the job is not done, that he doesn't see policy yet as too tight. And so, again, leaving open that door for further hikes. So that, I think, is, again, part of what has the market on edge, because you certainly are hoping, or the market has been hoping, for some relief in terms of pausing, but it's just not clear yet when that's going to happen.
And so what are then the implications for people's trading strategy right now? Are you recommending that clients get defensive in this environment when it comes to their equity allocation?
We're right now at a neutral posture on the equity market. And while there are risks, like we have been talking about, the fact that rates have been moving upward really for the most part, even though, again, some back down today, as well as, continued tightness in monetary policy and economic growth generally slowing. On the other hand, we have still a very resilient consumer. And you see that in Red Book sales, you see it in the retail sales number we had it earlier week, and you certainly see it supported by the jobs market. And so really, you've got this balance of puts and takes right now. And so we really feel for clients to be neutral to whatever is typically their long-term allocation to equities makes sense.
And Lisa, in equities, as much as you're neutral on the market, do you see opportunities in more maybe defensive sectors? Is it utilities or staples?
Well, certainly, as we look at year-to-date performance, one of the areas that really has lagged, even relative to some of the declines we've seen recently, is the defensive sectors and some of those more income-oriented sectors like utilities, like consumer staples, and with the nice income and cash flow they can offer over time and at now even more compelling valuations, we do think they may be of interest for clients with time horizons further out than a half a year.
Further out than a half a year, because I think of some of these groups as well when we talk about defensive sectors as those that don't necessarily perform well when interest rates are high, right? When you talk about real estate or utility. So is that why you sort of have that longer time horizon caveat?
Absolutely, because in the near term, to the extent we've still got this upward rate momentum, they could continue to see some valuation compression. But again, for those who can look past that and hold for a little bit longer term time horizon to take advantage of eventually, hopefully, sentiment shifting, as well as, again, those ongoing income streams from dividends, that should be helpful.
And Lisa, in general, I'm curious what you're hearing from clients right now, right? It's sort of an unusual moment. There's a lot going on in the geopolitical stage that is making people feel worried, right, from an emotional perspective, even if it's not necessarily having a direct effect on the markets. You know, earnings so far have been coming in pretty well, right? As you said, the consumer spending's holding up pretty well. Give us a vibe check, for lack of a better term, on what you're hearing.
Well, certainly uncertainty is the word of the day, not really only in markets with this volatility that we've been seeing, but across all of the market participants. And I think it really is coming from the combination of the fact that we're at an unusual economic inflection point. We certainly have never had in recent history, such dramatic events as almost total shutdown from the pandemic, then, sort of the rebound as people were able to release. And on top of that, quite a bit of monetary and fiscal stimulus. So exactly how this plays out, how quickly the remainder of the path to inflation makes it down to that 2% target is all unclear. And to your point, we now have some extra forces on energy and some conflicts worldwide that, again, just raise the level of uncertainty. So again, that is helping us to contribute to our neutral positioning right now on the stock market. But again, I think just watching how these events unfold because of that higher level of potential volatility and uncertainty is really a word of the day.
Lisa Erickson, thank you so much for joining us, Lisa.
Thank you for having me.
Let's get to some trending tickers now. GM stock, that is on the move following its latest offer to UAW workers, which included an increase to its hourly wage to $40.39. It comes ahead of a live statement being made by the union's president, Shawn Fain, in just under an hour. So this right now, Julie, we're at, 5-6 weeks, I think. So the reports that I read said that GM and Ford and Stellantis, their negotiations with Shawn Fain, the UAW, have accelerated. And GM now saying that, yes, it would offer most UAW workers at $40.39 an hour. And that raise, from what I'm reading, combined with the cost of living increase, that would actually get total pay hike closer to 30%,
right,
which is the minimum, of course, that the UAW, it seems like, wanted here.
Right, and it seems like the Ford and Stellantis, whose offers are out there as well, it seems like that they're all sort of going in that direction and perhaps getting a little bit closer with the UAW on a deal for that reason, because Ford and Stellantis, and in particular Stellantis, the offers that are on the table from them were already sort of closer to what the UAW was looking for here. And all of this also includes cost of living increases.
Yep.
It's not just that first bump up, it's over the lifetime of whatever deal they come to. So as you say, we'll hear from Shawn Fain at 4. We'll be paying close attention to whatever T-shirt slogan he has
I can't wait for
going
the
on.
T-shirt. Yeah, that can get colorful very quickly.
What kind of message he's sending out there. But it should be interesting to see if there is any kind of resolution on this as the economic costs keep mounting.
As you noted, it gets complicated quickly because, yes, you're talking about wages, but it's pensions,
Yep.
it's the battery plants, 34,000 already off the job. So we'll see what Mr. Fain has to say.
Yes, we will. Let's also get a check on shares of Oracle. This is a bit of a head scratcher today. The shares are down. It held an AI forum event aimed at showcasing the company's products that allow artificial intelligence models to be trained at scale. Seems investors didn't necessarily like what they heard. The shares are down 6%. Some Wall Street analysts have come to the company's defense, saying that it has long-term potential. But it might be that key phrase, long-term, that is the issue here. Because indeed, the likes of JP Morgan says the conversion of bookings to revenue will take longer than we think, steering more growth into fiscal 2025. And it does feel like we are at the stage in the AI hype cycle where investors want more concrete monetization.
Show me.
Right.
Yeah.
So maybe
fresh revenue.
Yeah.
Right. No, I think that's true.
Exactly. So that could be
to
what's
your
going on.
point, one guy, when it comes to enterprise software, I always make a beeline for is Kirk Materne over at Evercore. Smart guy. He's been following Oracle for a long time. And like you said, Julie, there was this sort of rush by the street to sort of defend Oracle. And Kirk says, while we are still in the early innings, we believe Oracle is well positioned to capture AI mindshare at the enterprise level. So you did see kind of analysts coming out to defend Larry Ellison's company here, but at least in today's trade, investors not so convinced.
No, doesn't seem so.
Nope.
Not so convinced about regional banks either.
No, let's get to that. Nice transition, by the way. Regional bank stocks under pressure today as more earnings reported before the bell. Regions Financial falling to its lowest level since March. It's after adjusted earnings per share missed estimates, and its net interest margins were lower than consensus. Meanwhile, Comerica had better results, beating on average deposits and EPS, but its current quarter outlook sending the stock into the red. And look at that. I mean, both are down very hard in today's trade. I'm just looking at Regions, Regional Financial in particular here, 49 cents a share. That was a miss, Julie. 1.3 billion in net interest income. That was disappointing relative to expectations too. And I think the key here, they expect more declines in net interest income to come.
Yeah, they're seeing higher deposit and funding costs, right? You know, people want more return on their investments, so they're putting money in money market funds, for example. So all of this is costing the regional banks like Regions. Another interesting line that caught my attention from Regions' report, it continues to take a hit from check fraud. And it's interesting, I don't know if there's any connection, but it's interesting that we're seeing an uptick in so-called shrink at the retailers, theft at the retailers, at the same time that we're seeing an uptick in check fraud. So the company took a one-time charge of $53 million tied to check fraud. It's not huge, but it's notable. And it already had an $82 million dollar loss tied to a different check fraud scheme last year. So this is something that has been happening. On the other hand, over at Comerica, it is victim of some of the same net interest income dynamics. For the fourth quarter, it says net interest income is going to fall 5 to 6% quarter over quarter. That's similar to what we heard from Regions as well.
Yeah, to your point, these regional banks, they have to offer these higher interest rates to customers. That eats into what they're earning on lending. That impacts your earnings. It was interesting, the CEO of Regions Financial saying here, you know, the industry, we're facing economic and regulatory uncertainty. He tried to put some optimism here. We're confident, he says, in our ability to adapt, but at least today's trade, investors not giving him the benefit of the doubt.
No, it doesn't seem so. All right, we're just getting started here on Yahoo Finance Live. Coming up, our conversation with Eurasia Group's Ian Bremer on the Israel-Hamas war. He's going to tell us whether or not he thinks the U.S. military could become directly involved in the conflict. And later in the show, we're going to preview big tech earnings, Microsoft, Google, Snap, Meta, all of them out with results next week. And subscription fatigue. Elon Musk announcing 2 new subscription tiers for X, formerly Twitter. We're going to break that down, and we'll have all that and more when Yahoo Finance returns. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The Biden administration has put in a formal request to Congress to approve nearly $106 billion in foreign aid, including for both Israel and Ukraine. The president made his case to the American people last night in a speech that both regions are vital to U.S. security. Earlier today, we spoke with Ian Bremmer, president and founder of Eurasia Group and G0 Media. Here's what he had to say about the conflict.
It's going to get worse before it gets better. The Israelis are about to begin a ground invasion of Gaza within hours, if not days. The United States would like them to not do that because it's going to lead to enormous civilian casualties and greater radicalization. But understandably, the Israeli government, and here I'm not just talking about Netanyahu, but the broader war cabinet, are responding emotionally and with a focus of retribution, given the worst violence that the Jews have faced in the world since the Holocaust. So, I mean, it reminds me of a couple weeks before the Russians invaded Ukraine, and we all knew it was coming. The U.S. had the intelligence. We were trying to convince the Russians this was a really big mistake. They shouldn't do it. And they did it. And, you know, it's kind of this feeling of inevitable. Now, in this case, I mean, it's not an enemy of the United States. It's a friend of the United States. But the feeling is the same, that a big mistake is about to be made that is going to have long-term implications. The Americans would like to prevent it, but it's not going to be prevented. And so we're not on a path towards resolution. We're in a defensive crouch, try to stop what is an expanding war from engulfing the entire Middle East.
Now, we also asked Ian Bremmer about the possibility of U.S. military involvement in the conflict, and he did not outright deny it could happen.
I think with hostage rescue, they will not. Despite the fact there are 11 citizens that we know are presently being held hostage in Gaza, though we don't know how many of them are alive. The White House has made clear that the Israelis are in the lead. They are the ones that are taking the decisions, all of the decisions on hostage rescue. And at least from their public statements, the Israeli government has been talking about leveling all the tunnels, destroying all the Hamas capabilities, and that they won't be responsible for what's on the ground. That means that these hostages are going to be at greater risk. Certainly, that's true as soon as you have ground forces that come into Gaza from Israel. Now, the United States has sent 2 aircraft strike carrier groups into the Eastern Med. And that is a very strong and direct message to others in the region that the Americans will directly respond militarily if the U.S. is attacked. And we've already seen drone strikes against American bases in Iraq, for example. We've seen some drone strikes that might well be attacks on American ships. The possibility that the United States is directly involved in this war in at least a minimum way, I think is reasonably high. Again, that's very different from the U.S. is at war with Iran. But, in the case of the Russian invasion of Ukraine, the United States made very, very clear red lines that they're going to provide a lot of support for the Ukrainians, but there will be no direct NATO fighting against the Russians. In the Middle East, that is a very, very different story. I think that there is an absolute expectation that there are plenty of things that could happen going forward that would bring the Americans directly involved in fighting.
Bremer also commented on American leadership amid the conflict. The House is still without a speaker. That makes it difficult for Biden to execute on promises to financially back American allies. And Bremer says this could have consequences for American adversaries.
The last 2 weeks have been the best weeks for Putin since he invaded Ukraine a year and a half ago, to almost 2 years ago. I'm not happy to say that, but that's a reality. He has a lot better path at this point to be able to secure territorial gains that he has illegally seized from the Ukrainians. What are we going to do about that? It's not clear what we're going to do about that. And so I do worry that, of course, the days of America's role as global policemen are behind us. I'm the guy that coined, after all, a G0 world over a decade ago, not a G7, not a G20. So this is what happens when you have an absence of global leadership, when the Americans are not capable or willing, but nobody else can step in their shoes. What we are seeing is that if the Americans don't play the role to support the Ukrainians militarily, they will lose. And if the Americans don't stand up for Israel, the Israelis will lose, right? And that's a real challenge, especially when a lot of Americans are saying they're not really interested in doing that.
And against this backdrop of conflict, we asked Bremer about the impact to global economies. Here's what he had to tell us.
Well, it's strong dollar, right? America first as a concept, in part, comes from the fact that the United States geostrategically is located between Canada, Mexico, and two big bodies of water. So, the Middle East blows up, and a lot of that becomes a big problem for governments in the region and spill over into Europe. Russia invades Ukraine. If that goes badly, think about the money that the Europeans will have to spend on defense at a time when the military consequences are fighting against higher debt servicing, they're fighting high against greater inflation, and they have higher input costs for energy, and they have all of these challenges in terms of asymmetric attacks from Russia. Well, what about the United States? Seems like a good place to invest. So I do think there's going to be spillover. I do think the market consequences will be significant, but investors are going to look at that as comparatively, U.S. is the better call.
Our thanks again to Ian Bremer. And coming up, solar stocks sliding. We're going to break down the reasons behind the tumble next.
Solar stocks getting slammed on Wall Street. The move's coming after SolarEdge cut guidance and warned that demand is weakening in Europe. Those shares down by 28%. Joining us now is Jordan Levy, Truist equity research analyst who covers this space. So how bad is the situation here in terms of demand for rooftop solar right now, Jordan?
Yeah, I think it's an evolving story when it comes to SolarEdge. I think, much of the story on the U.S. demand picture has been written in terms of how much that's fallen off. Europe was seen as, kind of more of a safe haven, and we're just starting now to see, some of that demand slow down. And so it kind of remains to be seen how much that's going to fall off. I would say the economics in Europe are still a lot more favorable for rooftop solar than they are here in the U.S. right now. But it's a question we're going to get a lot more answers to, I think, in the coming months.
And Jordan, any insight though why you think we might be seeing this softening demand in Europe for SolarEdge? I mean, is any of this, is it somewhat seasonal, Jordan, and just more than maybe the market was expecting? What are the reasons you think for it?
I think there's two aspects of it. One, Europe is going through this phase of destocking of inventory on the solar side, right, where a lot of the distributors there loaded up on solar panels at a high cost last year into this year, and those prices have plummeted, and now they're left with a lot of excess inventory on all their equipment, and so they're really struggling. So you're seeing a lot of that inventory destocking process hit SolarEdge, and the other component of that is the rate phenomenon. I think is global, in that these are large capital purchases, even if they are less expensive in Europe than the U.S. That still can have an impact on the homeowner's decision whether to purchase these or not.
And Jordan, for those who have not been following it closely, what are the dynamics then in the United States? Is it tied up not just with higher rates, but also with the sort of lack of movement in the housing market?
Yeah, so the real impacts to the U.S. are, by and large, rates are the most important thing hitting demand. Along with that, you have California's change in its net metering policy that went into effect earlier this year, California being the biggest market for rooftop solar, that's hitting demand as well. And then you have this kind of abnormal year where energy utility prices have sort of stabilized or even come down in some instances, and that's sort of a third hit to demand. So you've kind of got these three things all hitting U.S. demand and kind of exacerbating the issue of rates.
And going back to SolarEdge for a minute, Jordan, I was interested, because my understanding is an Israel-based company. Did the Israel-Hamas war have anything to do with how their business outlook there?
The company was adamant that their operations are up and running and everyone is safe, and we checked in with them. And so I don't think it has anything to do with that. I think it's purely sort of the European dynamics.
And Jordan, it's my understanding that you still have a buy on shares of SolarEdge. So are you expecting a recovery here in demand? And is anything going to change that except some relief on the rates front?
Yeah. Look, I mean, where we look at is how much has the price fallen relative to, what the new sort of numbers they're putting out there suggest. And it just kind of doing some back of the envelope math here, it looks like the stock is pricing in sort of a worst case scenario over the next few years. So we think if you go out, 2-3 quarters, the picture starts to look a lot better as you get some confidence in what the rate environment is going to look like, and you get some overall recovery on the European destocking process for the distributors and that sort of thing. So really that's how we're thinking about it. But we recognize there could be more volatility in the next quarter, couple months.
And at this point, how reliant is the industry on incentives, on government backing for the industry and for individuals who buy these?
I think in terms of the U.S., the IRA has done a decent amount for rooftop solar, but I don't think we're at a point where it offsets the rate pressures for the homeowners. So I think that still leads the conversation more than anything else.
Jordan Levy from Truist, thank you for your time today, Jordan.
Thanks for having me.
And while stocks are moving lower, investors are seeking some safety in gold. Prices edging higher. Jared Blickery is on the floor of the New York Stock Exchange with more. Jared.
Hey Josh, we have had a really impressive run-up in gold over the last couple weeks. Let's go to the Wi-Fi Interactive. I'm actually showing gold versus bonds because something really interesting has happened. They have diverged very recently. Now, these two asset classes don't track each other tick for tick, but they do generally go in the same direction, and you want to pay attention when they diverge. So you can see on the interactive how we're tracing out the very similar paths until recently. Bonds sold off a lot more, and this is inverse to yields, by the way. And only within the past few days, we have had a divergence, and that is with gold trading up and with bonds also continuing to trade down. Now, I want to take a longer term look at gold and just kind of paint some different scenarios. When gold rises, it can be from different effects. We say that gold is an inflation hedge. It's also an Armageddon hedge. But usually when gold doesn't track what's happening in the bond market, we have to look and see what could possibly be going on, because we've had a number of good rallies in gold over the last few years. Those were confirmed by the bond market, but you'd have to go back to, say, 2006 to 2009 to find an episode where they were diverging like this again, and we are seeing that. I was talking with Macro Alf, that's Alfonso Picatiello of the Macro Compass, about this, and he's saying that the run-up that we're seeing is very similar to what happened in 2007, actually 2006 to 2007. That's when the Federal Reserve went on pause. Interesting to say that we did get a rally in stocks, we did get a rally in gold, but of course deflationary forces in 2008 took over. First we had Bear Stearns. Actually before that we had SocGen. Jerome Carville blew up a hedge fund at SocGen. Then we had Bear Stearns, and then we had Lehman Brothers. All of those deflationary forces were then countered by QE and massive expansion of the Fed balance sheet, and that's when we got this big rise up here. So what's happening with gold right now? Difficult to say. One interesting theory is that central banks are dumping their dollar holdings to buy gold. That could be China, it could be Russia. Russia's already done quite a bit of that in the past, and to be fair, China has too. But there are evidence in the swap market that that is one of the things that could possibly be happening.
So from gold to another important commodity today, Jared, oil prices, which had been strengthening lately but pulling back a little bit today.
Yes, black gold. So let's talk about that as well. In general, commodities are mean reverting, meaning that they tend to have much more cyclical, they're much more cyclical with their highs and lows to nominal prices relative than just relative changes here. So going back to the Wi-Fi Interactive, we can see over the last 3 months, we had this high here that was on the Gaza incursion, then we sold off a bit, and now we're just trying to find a footing. But I want to show you what happened last year. This was the Russian invasion of Ukraine. That was that peak right there. We are nowhere near those highs. So if we're talking about geopolitical unrest, we've yet to see that really affect the market in a big way. And when it just comes to other fundamentals, I was just talking about gold and how there are similarities to the global financial crisis. I want to also measure WTI crude futures as they move throughout the financial crisis. Now, crude topped in 2008 at $150 per barrel. That was when not only was the Fed pausing, but also cutting rates. This is to say that there's often a late cycle rally in crude oil, and guess what? We haven't even had that yet. So Jamie Dimon was looking for $150 oil when he was speaking to the media a couple weeks ago before earnings. I think that's definitely in the cards, or something higher. Just don't know what that catalyst is going to be just yet.
We will be watching. Jared, thank you. Coming up, the Ozempic frenzy continues. Now children as young as 6 years old reportedly may soon be able to take those weight loss drugs. This is early, though. We'll give you all the details after the break.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Children as young as 6 years old may soon be able to take weight loss drugs as a treatment for obesity. Producers Eli Lilly and Novo Nordisk are reportedly carrying out clinical trials. Anjali Kamlani is here with more. Obviously, we've been watching this space very closely, Anj.
That's right, Julie. As you know, the drugs have definitely taken off, but what is being planned is a little bit different than what you might expect. So Eli Lilly making a plan to test its drug Mounjaro for type 2 diabetes right now, but they are planning and are waiting for the FDA to approve it for weight loss to kind of rival Novo Nordisk's Wegovy. And that drug is the one that Eli Lilly is using to test in kids as young as 6. So ages 6 and older would be tested in this trial. They have already put out sort of that signal on the clinicaltrials.gov. That's the registry used by companies to signal their intent to start this clinical trial. So they'll be starting enrollment, something that we knew was kind of in the works, but now we're seeing that green signal. But meanwhile, also Novo Nordisk has had its own plans to test an older GLP drug, Saxenda, that's liraglutide. It's different from its blockbusters right now, semaglutide, an older drug which is just a little bit less effective with the weight loss percentage, but still has been part of that GLP-1 category for some time and would be and is its older weight loss drug that is being tested in kids 6 and older. There already has been a test from Eli Lilly's Mounjaro for ages 10 and older. So this is just shifting that age group back a little bit. And this is a conversation that has been happening for some time. And there are some critics of the idea, some experts saying that especially because of the side effects that you do see with the adults, that it might be concerning to have those in kids. But we will see what those test results show when they do come out. We don't know yet how long these clinical trials will take.
And Anjali, final question here. Eli Lilly making other headlines today as well. It is taking legal action against foreign importers. What can you tell us there?
That's right. We, of course, know that Novo Nordisk the other day was also facing similar issues, really looking at counterfeit products or potential counterfeit products on the market with these injectables with such high demand. Eli Lilly now joining a filing with the U.S. Trade and International Office with potential counterfeit products overseas. And so they're looking for ways to kind of stop this flow of product, especially because there have been reports of potentially harmful ingredients in these. These injectables are really rife for that. There have been a number of products. So compounding pharmacies, for example, have taken advantage of the shortage of some of these products and been able to, make them with similar or different products. The FDA has had to come out and create warnings for this. So it's really quite a robust time for these products, as you know. And as a result of that, Eli Lilly now also chasing after the production of some of these products that they're finding potential counterfeits for. So definitely, buyer beware, consumers be warned when you're looking for those prescriptions to make sure that they are getting the right product.
Oof, good to know. Thank you so much, Anjali. Appreciate it. Well, coming up, we're going to dig into and look ahead to tech earnings next week. Keep it right here. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Big tech is gearing up to report their latest quarterly results next week. Investors waiting to hear from Microsoft, Alphabet, Meta, and Amazon. As the Magnificent Seven have made the S&P 500's gains more concentrated, the pressure is on for big tech to deliver. Here to discuss is Daniel Flax, Neuberger Berman, Senior Research Analyst. Dan, it's always good to catch up with you about big tech, and especially it feels like right now, because you have sort of the individual big tech, and then you have the macro factors right now, and namely higher rates that have proven problematic for these stocks. How are investors to weigh, say, a 5% 10-year against the earnings that we're going to be getting?
Good to see you. I think interest rates will continue to play a factor, but what I believe is more important for these companies, if we look ahead to next week, Microsoft, Alphabet, Meta, Amazon, is really their ability to innovate and execute on their product cycles. That I think will matter most to their growth and ultimately their share price over the next 12 to 24 months. If we step back, interest rates have moved up significantly, but by historical standards, they're at reasonable levels in my view. And so, for example, we'll look at the cloud growth from Amazon Web Services, Microsoft, and Google. I think that will remain healthy, even in the face of some cyclical pressure. And of course, I think search and this move to infuse artificial intelligence is really in its early stages. So we're focused most on the product cycles and how that translates to growth.
And so, Dan, let's dig into some specific names here. Maybe begin with Amazon. I'm interested in that name. Obviously, the focus there, Dan, is going to be on, I think you mentioned AWS, the cloud computing business. That's the profit engine. You know, investors got used to 30% plus growth rates, now 12%. What are you looking for from AWS, Dan, in this quarter? You think they can start reaccelerating there?
I think what we'll see this quarter and the quarter beyond is low double-digit growth. I think as we move into next year, compares will get easier, which will contribute to a reacceleration. I think what we're most focused on, though, when we speak to customers, a lot of the new workloads in areas like artificial intelligence are in their very early stages. And so what's interesting and really exciting is that a lot of these new technologies have still yet to find their way into the enterprise, into academic environments, really across the spectrum. And so I think that will contribute to reacceleration for Amazon Web Services next year. And I think the setup is very interesting at current levels.
I guess you really have to look longer term, though, Dan. If you're doing, you're not looking to next week's earnings, for example, to necessarily get more concrete evidence of how some of those newer technologies are playing out. Are there names within the space where you say, right now, you're seeing monetization of some of that?
What's interesting is that with Google, with Amazon, they are currently monetizing a lot of these newer technologies. If we step back and think about Google in search, they've been infusing artificial intelligence to drive recommendations, results, value for users on one side, and then value for advertisers on the other. Amazon has been doing the same with machine learning. And so today and over the past several years, and most importantly, as we think about the next several years, these companies are monetizing artificial intelligence and the technologies associated with it. What we see, though, is that they're investing tens of billions a year annually in capital expenditures and R&D, and they're doing that because of the demand for these new capabilities, both internally and then from their own customers. And so we will closely see what the data presents next week, but we like them both short and medium term.
And Dan, another name, a big tech name that's leveraging AI is, of course, Meta. I'm just interested in your thoughts there, looking forward. What do you expect to hear from them? Mark Zuckerberg has talked about, the year of efficiency, and I'm curious to hear whether you think that continues.
I think they're doing a good job transitioning the business into and driving growth in some of the newer areas like Reels, short-form video, business messaging. They're continuing to see traction. They have, of course, moderated their level of investments relative to the past this year, and that has helped drive better earnings. I think we'll see strong results next week, and I think the outlook will be healthy. What we're focused on there is really their next wave of investment around artificial intelligence, around giving advertisers tools to help engage and attract new customers. And so they, too, I think, are effectively leveraging AI to drive growth.
Dan, when I looked over your list of stocks you're looking ahead to, companies you're looking ahead to earnings, there's one that sticks out to me that is not like the others. And that is Motorola Solutions, which sticks out because it's not one of the so-called Magnificent Seven. It's not one of the gigantic tech companies that we talk about, virtually on a daily basis here. Why Motorola Solutions?
Motorola Solutions sits at the heart of the transformation of the public safety infrastructure. A lot of the men and women on the front lines, the police, the fire, they use their walkie-talkies for mission-critical communication. These are solutions that they need. The key, though, as we think about the next several years, is Motorola, under CEO Greg Brown and his leadership team, have been investing in newer areas like video, like analytics. For example, a lot of the 911 centers in the United States are unable to take in video and text. And so we see a transformation of the public safety infrastructure, and Motorola and its solutions are really sitting at the heart of it. So we see faster growth, continued margin expansion, and really a flourishing of their ecosystem as they help really keep our communities safer.
And Dan, I'll get you out of here on this. I want your take on Apple before we let you go. You know, reports on November 2nd. And we get this every year, Dan, heading into the report. You start getting these different reports. Some are bearish, some are bullish on the new iPhone lineup. I'm interested, Dan, get your take on that new iPhone lineup. How do you think demand is actually holding up right now?
We like the new devices, particularly when you look at the Pro. I think the industrial design changes with the titanium are notable. The continued improvements to the camera and the video, which are really at the heart of the experience for many of us. And so what I think is important is that the install base is continuing to grow. And while there is pressure on consumers, China, of course, remains challenging in the near term. I think the business remains durable. And so we'll get a little bit more color on demand in the very near term. But as we look out to next year, I think we'll see better growth given the durability of iPhone. I think services is reaccelerating. And so this continued broadening of the growth drivers, coupled with an ecosystem that's incredibly vibrant, I think positions Apple well. So I still like the stock, and I think the name remains attractive at current levels.
Dan Flax, obviously here, a little excitement ahead of the bell behind us here. Thanks so much for your time. Have a great weekend. We'll see you soon. And there we had the closing bell on Wall Street. As you see, 3M ringing the bell here and pounding the gavel on this Friday afternoon. So as we close you out, let's take a check of the markets here and how we closed on the session. We closed pretty much at the lows of the session here, which is interesting, especially going into a weekend. It definitely shows some trepidation on the part of investors. The Dow lower by 288 points here. That's a drop of 0.9%. The S&P down about 1.25%. That's a drop of about 54 points. And the Nasdaq leading the declines. That's a drop of about 1.5%. And just wanting to take a little bit more of a look here, if you take a look at the Wi-Fi Interactive, I'm looking at the Nasdaq 100 in particular, because we did see this selling in the Nasdaq overall. There is not much green on this panel, folks. Tesla off by 3.7% on the day, continuing the selling that came in the wake of the company's earnings report. This is the 5-day chart for Tesla, off by almost 16% in that period of time. That's the one that really stands out, but we also have Amazon on the list here, off 3.5% over the past 5 days, even ahead of some optimism that Dan Flax was just talking about going into its earnings report. And then I just want to quickly equal weight it so we can see the worst performances in terms of percentage. Okta on the bottom here, off by 11.5% on the day. Zscaler, Palo Alto also on that list. If we switch it over to sectors here, you got tech that is the worst performing group. Not surprising given what we just showed you. But energy also falling as we had oil pullback, and consumer discretionary also seeing some weakness. All of these sectors in the S&P lower on the day. Just very quick look at the week here as well. Energy and consumer staples up on the week. Consumer discretionary and real estate down the most on the week. Let's get to some individual movers here as we move a little past the closing bell here. We are watching shares of AT&T, not just today, but on the week as well. Scotiabank upgraded the stock, raising its rating from sector perform to sector outperform, and the firm noting AT&T's optimistic wireless and broadband trends. It's been an interesting week for AT&T. It was only up about 0.8% today, but the Wall Street Journal flagging today was its best week in a year. It's had a bad year, to be clear.
It's down nearly 20%.
Yeah, and it also, at one point, traded at its lowest since 1993. It's really been a rocky year for the telcos in general, right? And AT&T has certainly participated in that. The company did report earnings earlier in the week. That then gave it a lift, and then the analysts sort of piled on and gave some positive commentary.
Yeah, so profit beat, revenue up about 1% to $30.4 billion. Looks like mobile subscriber gains. We know there's a lot of competition, of course, between the big carriers to grab those customers. Raise its free cash flow guidance. As you said, we did get some positive commentary on the news. You know, Citi was telling its clients, it says the report supports AT&T's opportunity to sustain growth in its strategic products. buy with a target of 17 is what they told their clients. But like you said, edged higher today, but has been rough sledding for the year.
Yeah, so we'll see if this is the beginning of some kind of turning point or it's just a blip when it comes to this performance.
Find out.
Yep.
Moving on, Merck inking a deal with Daiichi Sankyo. Merck to pay as much as $22 billion. The companies to jointly develop and potentially commercialize antibody drug conjugate candidates. Shares of Merck, let's say, did today about 2%, Julie. So I guess agree to buy the rights to sell these 3 experimental cancer drugs. In terms of the number, Julie, Merck's going to pay $4 billion up front, as much as $22 billion to develop and market these 3 cancer drug candidates. And I guess the strategy here is for Merck, let's add some drug candidates to our oncology portfolio.
Yeah, like many of the large drug makers, they have some things whose patents are rolling off. And in particular, Merck's drug Keytruda, which is its best-selling cancer therapy, is going to lose patent protection later this decade. So it is trying then to expand out into, look to the future. What are going to be the next big cancer drugs of the future? That's what this bet seems tied to. Keytruda is a big drug for the company. It's going to enter, though, government negotiated pricing. That is going to be happening in 2028 when it's going to reach $33 billion in global sales, according to estimates. So again, you get a sense of how big this drug is, but also how big the cancer opportunity is. And that Merck is not alone, certainly, among the big drug makers looking for those opportunities globally.
And like AT&T, though, some green today, but again, not an easy year for Merck, down about 10% so far this year.
Yeah, good point. Speaking of downdrafts, unfortunately, another one to add to the IPO list. Klaviyo shares now slumping, with the company trading below its IPO price of $30. The company joining its peers that went public in September that are also struggling since their debuts. Klaviyo had been doing better, right?
Yeah.
It had been kind of
that was the bright spot.
Standout here, off by 3% today. And I was looking at some of the numbers. It's got, or I should say recommendations. It has 8 buys, 4 holds from analysts. The price target, the average price target, if you put them all together, is almost $39. Yep. But, this sort of macro pressure, if you will, just is not helping these guys.
We had this trickle of deals, ARM and Instacart, Birkenstock, Klaviyo, and we were talking with a lot of smart venture capitalists on this show. Does that sort of trickle turn into a stream, maybe a flood? This doesn't help that. I mean, when you see the public market reception to these deals, throw in all the uncertainty, domestic and foreign, it's hard to see how a lot of deals get done in that kind of environment.
Risk aversion seems to be the name of the game right now.
Yep. As President Biden campaigns for re-election, the president has been making efforts to win over skeptical Americans. However, the curveball might give Biden the political break for another term as president. Here with what to watch there is Yahoo Finance's very own Rick Newman. Rick.
Hey guys, just about every week Biden gives a speech on the economy, sometimes 2, 3, or 4 speeches on the economy. Not much lately. And why is that? Obviously, he's got more important things for the time being to talk about. Making the case last night to the American people for basically $100 billion in additional funding for Ukraine, for Israel. And Biden is, right now, he has become a quasi-wartime president. The United States is not at war, thankfully, but it is supporting 2 nations that are at war. So the question is, could this help Biden politically? You could argue that foreign policy and foreign affairs is Biden's strong suit. He spent years in the Senate, some of that time as chairman of the Foreign Relations Committee. He has deep experience, as he has been reminding people. This is one area where Biden's age might actually be an asset rather than a liability, since he has met so many foreign leaders and been to so many places. So he's gotten strong marks so far for his public statements on Israel. He has been pretty fair when he says we support Israel, but we also are urging Israel to be very cautious about minimizing any civilian casualties if or when they do. Well, they're already bombing Gaza and they're going to mount a ground operation there. So will this change anything about his presidency? I mean, depends obviously whether the world gets more dangerous or less dangerous over the next 12 years. But for the time being, we're going to hear less of Biden trying to get Americans to give him some credit for record job growth under his watch and for inflation that is finally falling back toward the Fed's target of 2%. He's going to be talking less about that and more about what's going on in other parts of the world. So a respite from the economic speak for at least a little bit.
It's going to be hard for him to get a W, though, on this latest plea for aid, right, including for aid for Israel and Ukraine, if the House can't get its act together.
I think he's going to get this package passed somehow. I think so, you know, the latest we know about what's happening in the House is Jim Jordan lost 3 times in his bid for the Speaker. He's now out. They're now going to try somebody else. Next vote for whoever, we don't know who, could come by next Tuesday. As the legislative train gets rolling here, what can happen is the Senate can create the legislation and then pass it to the House, which puts the House in the position of basically, at that point, it's no longer theoretical. And the House wants to have some say. They want to be able to shape this legislation. So if all they can do, if they're so handicapped because of the dysfunctional Republicans, all they can do is take what the Senate gives them and vote it up or down. I mean, that might be a thing that gets Republicans to say, okay, we finally have to get somebody here so we can help shape this legislation. Most of the analysts are saying there is a good chance this legislation is going to pass, maybe not $100 billion, maybe something less than that. But just keep in mind, just a month ago, Biden was only asking for $24 billion for Ukraine, and now he's asking as part of this big package for $60 billion. So the ask has gotten a lot bigger. So the Biden White House probably figures if we get a portion of what we're asking, that will be a win. I don't know that voters are going to give Biden a lot of credit for that. Foreign policy, foreign affairs is not something voters usually really get behind a president on. It's almost always the economy, but at least Biden has a chance here for a while to demonstrate some leadership on a different issue.
Yeah, it was pretty striking today in our conversation with Ian Bremmer, Rick. He pretty much said if Ukraine does not get U.S. support, it's not going to win the war. So, you know, it seems like the stakes are indeed pretty higher. We'll see if House Republicans can get something through. Thanks so much. Appreciate it, Rick. Have a good weekend.
You guys.
Coming up, subscription fatigue. X, formerly known as Twitter, will add 2 new premium tiers. We're going to talk about the change next.
Big companies are looking to capitalize on the power of artificial intelligence. One of those companies, of course, is HPE. Antonio Neri, the CEO of HPE, joins us really fresh off your Investor Day. Thanks for hopping on with us. We appreciate it.
Thank you for having me.
So what was the story regarding AI that you wanted to get across to your investor base?
Well, first is an incredible market that's going to transform everything in the business, in the society. And it's a market that 3 years from now is going to be $150 billion opportunity. And HPE is uniquely positioned because today we are the supercomputing market leader with unique IP that's totally differentiated from what others can do. And the reality is that we're going to provide customers a complete solution, including the infrastructure, the software, and the services to run large-scale supercomputing that they need to use to train and tune their models.
Last time we talked, you called out $1.5 billion of AI orders. How much do you have now?
$3 billion.
$3 billion.
Yeah, so that's only in the last 2 quarters, plus some in Q2. But the reality for the balance of 2023, we have booked $3 billion in AI orders. But as you know, in the AI business, in the supercomputing business, it takes time to translate that into revenue because the revenue recognition is after you turn on the system and the customer runs the workload. So the acceptance process is longer.
So when you say you have $3 billion in AI-related backlog, what are customers coming to you for? What do those orders consist of?
Well, yesterday we showcased a number of unique customers, mostly are in the development of these foundational models, whether it is for weather forecasting or whether it's for large language model. One of them is a company called Recursion, which is in the pharmaceutical. There's more in the molecular docking. So think about how they use AI to find cure for diseases or vaccination. And basically what they need is a virtual private cloud solution that's an AI native architecture so they can train and retrain the model with accuracy. And so we have seen a significant uptick demand from those type of companies that they need to train their models.
You and I have been talking about the rise and prominence of AI really since the start of the year.
Yeah.
Going back to the start of the year, what has surprised you about how things have unfolded since then as it pertains to AI?
The speed by which this model get developed, right? So when you think about the first instantiation of ChatGPT, maybe it was 100 or 200 billion parameters. Now the latest version, we are talking about 1 trillion parameters. When you think about what we do as a company, we actually already trained models that look like 1 trillion parameters. Think about the Frontier system, the exascale system we deployed for the Department of Energy, the one we are completing with Aurora, which is the Argonne National Laboratory. All those they actually can support up to 60,000 GPUs and 40,000 CPUs. Think about it as a one cohesive system. You run just one workload and you train, retrain the model that you need to drive accuracy because ultimately it's all about accuracy and completion rate.
Are things moving too fast?
I think the reality is that this technology has so much potential. And I think about this technology not different than the web and the mobile transitions we went through. It's going to change everything in our life. I think the AI is moving much faster than the previous 2 cycles, whether it was the mobility access that everybody got or Web 1.0. So definitely it's moving faster than we thought.
Do you view AI as an enabler of the workforce, or does it take away a worker?
No, I am actually convinced it's going to be an enabler of the workforce. I think the jobs of the future will change. They have all, this generation will have to understand and learn how to use AI in their jobs. Obviously, there will be jobs that will be taken away because automation will eliminate what I call mundane type of access. But I think, it provides the ability for this generation to learn in different ways and to do more value added in their jobs.
Do you think the street fully understands how AI is going to impact your business?
I don't think so. I think they're all learning. We are all learning for that matter, right? So I think about it a year ago, right? We were not talking about ChatGPT and other type of large language model. But it's not the large language model only. To me, it's the generative AI component that's going to be embedded in every application as a co-pilot of sorts or as an aid of sorts, and then ultimately make those processes way more efficient. So I think we're all learning. I think the street in particular trying to understand how you're going to monetize all of this, right? Because it's all great technology, but how you make money
nice.
for
It just sounds like a really good number. Right?
Yeah, but I think like any business, right, it's gone through the cycle of adoption, then, some sort of stability, and then, what is the business model around? I can tell you Hewlett-Packard Enterprise is making good money when it comes to AI. It is an accelerator for our shareholder value, as we demonstrated yesterday.
The stock has gotten hit because of the outlook. On a scale of 1 to 10, how conservative is that outlook?
Actually, the stock, I think, will recover because fundamentally the street has not yet understood the guidance. And we were clear, not just yesterday, but a couple of quarters ago. As you recall, 3 quarters ago, we announced we are selling the 49% stake we have in China. That provides a 17 cents in our non-GAAP diluted net earnings per share. But now we are executing it. That goes away. Granted that sometime next year, probably by the middle of 2024, calendar 24, we're going to collect $3.5 billion pre-tax. And so what we guided yesterday was the operational view of our non-GAAP diluted net earnings per share without the H3C contribution. When those proceeds comes in, we're going to assess what is the best return on invested capital. We were very clear yesterday that we don't intend to hold excess cash in our balance sheet. We also increased our dividends by 8%, so that's what we plan to do in 2024. But it's important also to realize that our GAAP and non-GAAP EPS have now converged. In fact, the difference between one and the other is just 1 penny. And the other thing is that remember that that 17 cents EPS contributes $200 million of free cash flow. So we took that out. So when you think about the operational view of the free cash flow, actually we are improving by 10%. So the real EPS guidance is up 4% year over year, and on a 3-year basis is the 7 to 9%. So I think the market needs to assess a little bit of that. What was disappointing, I have to tell you, is that 12 of the 14 analysts did not exclude the H3C dividend. They should have in their consensus, but when you're comparing a consensus...
They get paid a lot of money to figure these things out.
Well, I mean, they have to do their job, right? But I will say that when you have 12 of 14 analysts that still have that included in the consensus, by definition, you're going to be off, right? So I think the market is very smart. It will take care of itself. I'm not worried about it. What I'm really excited about is the fact we are transforming the company. We are pivoting to high growth, high margin areas. And you can see that in the numbers because when you think about the last 3 years, we had a TSR of 121%, significantly above the S&P 500.
The top line, the glide path compared to a couple months ago, do you see any slowdown, deterioration at all?
No, what we see is customers obviously taking longer to make certain decisions. But I always say that the IT component of their spend is going to continue to be very strong. I think, think about the challenges they have. First of all, they need to reduce costs in their operations. They need to implement more speed and agility in their IT. They need to spend less time running IT and more time innovating on IT. Obviously, cyber is a big concern. And then when you think about AI, obviously, if you're not embracing it, you're going to be left behind because to me, AI is all about transforming the business. It's not another technology for the sake of technology. And that's where, customers are going to spend a lot of energy.
Before we let you go, you're very much a world traveler, world leader, Antonio. Do you share just the concern among that your fellow CEOs have on the state of the world? I think Jamie Dimon called it one of the most dangerous times that he can recall. Do you share that sentiment?
Yeah, no question. We are living very turbulent times. The situation from the geopolitical perspective is very heightened. We see obviously challenging situations in Europe and now in the Middle East. Obviously, the situation between the U.S. and China has not gone any better. I think we all have a responsibility to make a contribution in trying to solve these problems, understanding that ultimately we have to think about business and society. And so that's why I'm very proud of what HP does every day, because we enable business, but also we contribute to society, which is the core of our purpose, which is to advance the way people live and work. Whether it's climate, whether it's cybersecurity, whether it's finding cures, whether it's solving some of the biggest challenges like world hunger, technology has a role to play. But definitely, it's one of the most challenging times I've seen.
HP CEO Antonio Neri, always great to get some time with you. Appreciate it.
Elon Musk today announcing 2 new subscription tiers of X, formerly known as Twitter. Yahoo Finance's very own Dan Howley has the details. Dan.
That's right. Elon's going to roll out 2 new tiers for Twitter X. I still don't know what to call it, really. The 2 tiers come in the form of one that's a lower cost. It'll have all the features of premium, but no reduction in ads. The other will have the same thing, but you would get no ads. Currently, if you pay $8 a month for X Premium, you pay $8 and you get half ads. So this all comes down to the advertising on the platform. There's no discussion of what the actual pricing is here. It's just a single tweet, as Elon Musk is wont to do. And so we don't really know what this means then overall for the company. But there's still talk about how advertising revenue is down overall since he took over. There's no real clear indication yet as to whether or not these subscriptions or subscribers for premium are actually doing anything to buoy the company overall. And so this, I think, is a way to potentially get more people interested in premium without them saying, well, why do I need to pay $8 a month for Twitter? I'm already paying, what is it, $20-something a month for Netflix. So I do think that this is still obviously part of his strategy to try to wean the company off of its dependence on advertising dollars. And again, that's something they continue to seemingly struggle with.
Dan Howley, thanks for that, and have a great weekend. And up next, we're looking at the winners and losers of earnings season this week. That's next.
Taylor Swift making music history today, announcing she's going back on tour after a 5-year break.
Pre-sales for her upcoming tour kicked off yesterday, but a surge in demand caused Ticketmaster's website to freeze or even crash altogether.
There's so much fanfare around the summer that has been Taylor Swift.
The Philadelphia Federal Reserve mentioned the impact that her tour had on the economy. Jersey sales for Travis Kelce up 400%. His podcast hitting #1 on the Apple charts, all because of Taylor. Taylor Swift for Taylor Swift.
Taylor Swift.
For Taylor Swift.
Taylor Swift is breaking the internet again.
Almost 1 year ago, singer-songwriter Taylor Swift began a journey that would change the American economy as we know it, starting with ticket sales for the Eras Tour. Over 3.5 million people signed up for Ticketmaster's verified fan presale, but only 2.4 million tickets were ultimately sold. The unprecedented demand created a frenzy that resulted in a congressional hearing against the ticketing company, all while solidifying Swift's status as the world's biggest pop star. The tour kicked off in March of 2023 and has since blown up headlines and even landed in Philly's Fed Report. Analysts expect the tour to pass the $1 billion mark during its international leg in March of 2024. That would be Elton John's nearly $940 million record for his farewell tour, which concluded in July. Swift's Eras Tour is also expected to generate as much as $5 billion in consumer spending in the U.S. People are dropping money on plane and hotel tickets, fun outfits and merch, $75 hoodies, $55 long-sleeve shirts, and we didn't even talk about ticket prices, with resale tickets selling between $500 to $7,000 a pop, and in some cases, even higher. And that economic impact has only grown beyond the tour, with Swift now rumored to be dating Chiefs tight end Travis Kelce. Ticketing platform StubHub reported a 175% increase in ticket sales after she attended one of his games. And according to fan merchandise company Fanatics, Kelce's jersey sales have increased by 400% since that first Swift appearance. And now her team is taking it one step further by releasing a big screen adaptation of her popular Eras Tour. Bottom line, the Taylor Swift economy isn't going out of style anytime soon.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal here with Josh Schaefer and Madison Mills. And we're talking a little earnings today. We got some winners, we got some losers, we got some companies that we're very excited to report. But I want to kick us off with the winner of earnings season, at least so far. And that, to us, is Netflix. So Netflix beat earnings on both the top and bottom lines this week. We also saw a surge of nearly 9 million subscribers thanks to its password sharing crackdown. We saw the stock go up by double digits in after hours after the report. That continued on Thursday as analysts praised the results. Netflix said it expects full year operating margins to come in the high end of its projection at 20%, with 2024 full year margins to be even higher, between 22% and 23%. We also saw ARM, average revenue per member, that was down in the quarter, which was expected. But Netflix did say they have a plan to boost ARM. What is that plan? Raising prices on some of those subscriptions in certain territories. So overall, analysts were just very bullish about the results here, especially at a time when Netflix shares, they had been pretty pressured coming into this report. And then we saw them really reverse that after the print. So all in all, pretty solid here.
Yeah, I mean, my biggest takeaway from Netflix earnings was really that stock move that we saw, because when you look at the overall market action this week and thinking about it in the context of earnings and what earnings can do for stocks, Netflix showed us you can still be a winner this quarter, right? Right now, when you've had yields at 16-year highs, you have worries about the Fed, a lot of things weighing on stocks, the Nasdaq down over 3% this week. I sort of came into this week just wondering, even if you report really good earnings, does it matter, right? Is that really going to matter for individual?
Last earnings season too. Even companies that were beating on EPS, they weren't necessarily seeing those returns in the stock market.
And you see Netflix investors get rewarded here. And to me, if I am a retail investor that invests in individual stocks, like some of the big tech stocks, which a lot of people do, it's a good parameter to say, okay, well, if my company does well, my stock might actually get rewarded, because I thought, given some of the macro headwinds, we just might not have seen that kind of move.
Well, and like you were saying, Josh, when you look at the overall market, I was looking at a stat that the options market had only priced in an 8% move on Netflix, and today it was 16%.
Yeah.
So totally missing on that, right? Like not getting the degree of the upside there. And also the cash flow piece, too, that you were mentioning is interesting to me because I always think of these tech companies as kind of not necessarily having the money behind the growth story, but it feels like that's kind of over for Netflix at this point.
Yeah, and free cash flow continued to impress. They continue to raise guidance on that free cash flow. Now, part of that is because of the ongoing actor strike in Hollywood. There's not a lot of content being produced right now, so that means they're going to have more cash on hand. But really, across the board, we just finally got more color from Netflix. Their advertising tier, it's still in that crawl and that slow phase that they've been preaching. That is probably the biggest concern for investors. Once they start to release some more data, once we start to get some actual hard numbers and figures, I think that's going to ease a lot of the minds of investors and analysts out there. But by and large, I mean, this wasn't just a beat on EPS. It wasn't just a beat on revenue. We saw a beat pretty much across the board, give or take a few
And the margins being key there too, but you wonder about the price hikes.
Right.
Do people, like, what does that do?
Analysts like it, but what does that mean?
What does that do to the actual consumer over the next 3 months before we hear from them again? That's what you're wondering now, I think, moving forward.
Well, speaking of the consumer, I'm going to talk about our biggest loser of the week. We've got airline stocks. Womp womp on the airline stocks heading for their biggest weekly slump in over 2 years. A big thumbs down from this week's reporters here. We've got Delta, United, and American Airlines. This is due to pricing pressure, right? This is because of those rising fuel prices due to that geopolitical conflict in the Middle East. It's also because of rising wages, 40% increase in wages for pilots across most of those airlines that I just mentioned. But just to go through some of those names, I'm going to start with Delta because they were the first to report that they had a beat on the bottom line, a beat on revenue. That put them in the green for a little bit after the report, but then sliding into the red after adjusting that guidance in the market, digesting that. American Airlines reporting earnings that topped sales, trailed estimates. JP Morgan cutting American Airlines today. United was such a brutal report that pushed American and Delta into the green for a little bit, but then again, as the market digested the rest of the week, heading into the red there. And it was interesting, too, looking at the Fed Beige Book this week. They talked about consumer demand for airlines not necessarily changing overall. So this is not a scary Fed story about or company story about consumer demand waning as we head into the rest of the year. It's really about that pricing pressure inside of the companies.
Yeah, guidance, too. I mean, there's kind of all these factors here. There's fuel costs, jet fuel costs. There's a tension in the Middle East that could impact guidance and margins moving forward. Helene Becker, one of the analysts that covers a lot of these stocks, for United specifically, she said the fourth quarter was bleak and worse than their estimates, worse than they expected. She added that given the projections that this will be a long war, we are looking at the lower end of the forecast range and assuming no service by the end. And out of all the American-based airlines, U.S.-based airlines, I should say, United has the most service to Israel and those Middle East regions. So it's one of those things that is weighing heavily in the background.
And I think it's just a stark reminder, too, that yes, earnings, we talk a lot about what companies just did for 3 months, but really the stock moves on what they're going to do over the next 3 months, the next 6 months, right? And that's so largely uncertain for the airlines. We just mentioned two big headwinds that we really have no insight into when they're going to end when you think about the tensions in the Middle East and then what that does mean for the price of oil and eventually the prices of fuel. We more or less don't really have good insight into that and how that looks 3 months from now. And I think that's really a large part of what these analysts are saying and what you're seeing in the stock action.
And United's CEO this week talked about that. He said that he sees the situation in the Middle East being, it's not going to be sticky. That's going to go away, but that's an interesting projection. Of course, the CEO is going to say that as they head into the rest of the year, right?
And Q3 is usually the best time for the airlines. So now you're facing even more pressure in the fourth quarter and beyond. So not the best there.
Well, I said we like to look ahead, right? We always like to look ahead with the stock market. Let's take a look at some earnings coming next week that I am very excited about. We have big tech. Always fired up for some big tech earnings. So we've got Meta, Alphabet, Amazon, also Microsoft reporting next week. And really, two big themes I think you can pull out of this, guys. One would just be the overall market action. We again talked earlier about the market sort of needing a catalyst right now. We know we have 4 of the Magnificent 7 stocks reporting next week. Can they send the S&P 500 higher? When you just think about how much of the S&P 500 is made up of those stocks, about 30% of the S&P 500 is simply just Magnificent Seven stocks. Can good earnings from them give us a catalyst to the upside is one thing I'm watching. And then overall, when we think about these companies, there's like 10 different companies within each of them, right?
Yeah,
we can learn so much. You learn a little bit about advertising. You can learn about the cloud sector. You can learn about AI, of course, is going to be a massive story. So I think you really get a good look at the overall state of the U.S. consumer, but also business-to-business spending when you start to go through these calls.
And with Microsoft, we're going to get so much of that AI story and the cloud story, and then we're going to have Google with the advertising story that you mentioned. We'll get some of those insights before Thursday, which is the big Amazon day. So I'm interested in seeing how much the earlier earnings in the week impact Amazon, and will we see another rip with Amazon like we saw with Netflix today?
Yeah, and I think it's what we saw with Netflix. It's possible if you can have those strong results, especially in this uncertain macro environment, especially at a time where interest rates are high, yields are high. I think that is incredibly important for a lot of these companies.
It'd be interesting to see what kind of scrutiny those two things bring when you talk about spending for these companies.
Yeah,
right? We talked a lot about CapEx and how much these tech companies are spending on AI.
13% for Microsoft,
Yes.
right? Which is a crazy allotment. And I'm so interested to read your reporting on this. Is that going to be good for them long term, or is that a little bit too much?
Last quarter, they said that AI revenue isn't coming until 2024, and the stock fell about 6% the next day. Right?
Yeah, again, it
people
comes
want
back,
that revenue
it
now.
Goes back to
Always.
that guidance story, right? Like people are looking ahead and they want to know that you're a company that's going to make money on these investments.
All right, we got to go spend our weekend preparing for big tech earnings. We got to go read up.
Yes.
But there will be more markets coverage on the other side. Stick with us here on Yahoo Finance Live.
The travel boom is still going strong. That's the main takeaway from earnings from America's biggest airlines this week. But the same cannot be said for the state of luxury necessarily, with companies like LVMH dropping around 25% since May. So what does this mean for luxury travel ahead of the holiday season? One company that combines the two worlds is Rosewood Hotels and Resorts. And the president joins us now. Radha Arora, thank you so much for being here. Appreciate it. So just give us some color here into what kind of demand you're seeing right now, particularly when we look at the state of travel on the one hand that seems to be holding up, but some chinks in the armor, one could say, for luxury demand, at least demand for luxury goods.
Well, first of all, thank you for having me. I'm happy to report actually it's good news from this camp of Rosewood, or this camp of hospitality community. We're having a banner year, 20% up previous year. And beyond that, the flurry toward the end of the year it's amazing. We're seeing that through the festive period, Thanksgiving, Christmas, it's busy, booming as ever. And in fact, so much so that it's actually 30% up on 2019. And the image that you see at the moment, Rosewood Kona Village, just opened about a couple of months ago. And it's one of those destinations where people are wanting to go to. It's been closed for a number of years. And so, yes, we're very fortunate that we've opened some amazing destinations, and these new destinations are being heralded by our customer.
And Rana, what are the top travel destinations right now? You mentioned one there, but what are some others? What are the properties people are making a beeline to?
So I would say currently, believe it or not, Hong Kong is 68% growth on previous years, so that's enormous for us. Paris, I will say, is having a banner year, probably the best year ever since we reopened Rosewood Hotel de Crillon back in 2017. And London, again, surprisingly, when people talk about Brexit and this that, and the other, is having another banner year. And I think that's probably because, business traveler is beginning to travel. And of course, the leisure traveler continues to travel. And beyond that, the resort destinations will always be those favorite destinations by families and friends, those multi-generational families.
Radha, I'm curious as well. Obviously, these are catering to high net worth individuals. They are luxury properties. What are some of the top amenities that travelers are looking for right now? And has that changed since pre-pandemic?
Yes, absolutely. What we have seen is the traveler today, as you said, individual, affluential traveler, high net worth individuals. They're looking for immersive experiences. They're taking their families, they're taking their friends, they're taking the time to really create a program for themselves for a long duration, longer duration than previously. So whereas previously people would go for 3, 4, 5 nights, probably do their extended stay, they'll do some business, they'll take their families with them. So they're traveling differently, and they're looking for value adds. And by value adds, I mean an immersive experience, and taking their families to these destinations where they want to be part of the local communities as well, and not just going to stay in a hotel and go and shop.
And Ron, I'm interested in these branded residencies you also offer here. Who is that for, Ron, and what's demand like right now?
Yeah, so as I said, people are traveling together, friends, families. They don't necessarily want to split each other up and stay in different parts of the hotel and different rooms and different suites. So what they want to do is go and stay in residences where they're under one umbrella, one roof, and get that full-on Rosewood experience. And we provide similar experience as we do in hotel rooms, as we do in Rosewood residences. But you have your own personal butler who will take care of your every need. And we find that this is really it's a trend that's going to continue to stay. It's a new norm where people will travel together and want larger accommodations.
And is that something that they purchase, or is that still working? Is there a monthly fee, for example, to stay in those kinds of residences?
No, it's actually something that we purchase. So, many of our developments like Rosewood Mayakoba, Rosewood Las Ventanas, Rosewood Carlisle, they have residences part of the feature of the property. So when the suites are all sold out, they can extend themselves into the residences. So the residences are available for them to actually to stay in. And what happens is once they've stayed in those residences, they'll want to come back and keep coming back because, as I said, you're not just in a typical hotel room. And so you can, yes, just rent them.
Radha Arora, thank you so much for joining us today, Radha. Really appreciate it.
Thanks for having me.
And coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
UAW President Shawn Fain wrapping up his weekly update just moments ago. There is no expansion of the auto workers' strike, but Fain stood firm to work on getting what he thinks is a better deal for his members. The two sides do appear to be getting closer.
The bottom line is we've got cards left to play, and they've got money left to spend. That's the hardest part of a strike. Right before a deal is when there is the most aggressive push for that last mile. They just want to wait us out. They want division. They want fear. They want uncertainty. And what we have is our solidarity.
Notice he was not wearing an Eat the Rich t-shirt this time. Joining us now, Autolist Editor-in-Chief David Underkoffler to talk more about this. So, does it feel like there's a deal or deals that are imminent here, David?
It seems like they're getting closer, right? I think most notably is what didn't happen on this call, and that there were no new plant closures announced. Basically, he went through line by line and said, you know, these are the things we've been arguing for, and then laid out how each of the three automakers had, you know, the case that they had presented up until now. So in that way, you could sort of see in which case each automaker was the lowest denominator. And I think what he's looking for is for there, you know, there to be parity across those key points he's been fighting for. And, you know, I think if we're getting closer, we may see that in the coming weeks.
And David, among the issues, it's interesting. So there's a lot of them. You know, it's wages, it's pensions, it's also the battery factories. So GM did agree to include the future EV battery factors in that UAW national agreement. David, I'm wondering, do you think the other big automakers also agree to that?
Ooh, that's a good question. And I think that's probably the largest outstanding question right now. Like, for all the talk, sort of the daily updates you're hearing about, it's wage increases, it's cost of living adjustments, it's increases to pension and retirement plans. But sort of in the background of all that is this sort of larger existential question of the impact of EVs. They're simpler to build, they take fewer people to do so. And so the UAW longer term is looking at, you know, how can we make sure that our workers are protected as the industry shifts towards EVs. So it certainly was a big step, a big win for the UAW to get General Motors to make that concession. I do think that's one of the areas that now they're saying, well, we have one win, right? We've got General Motors saying that. They're going to take that, and they're certainly going to use that as leverage to Ford, or with Ford and Stellantis. So yeah, that could be a big shoe to drop. And I would imagine, you know, if they do see movement there, that certainly that helps, you know, get us across the finish line.
Are we also going to get the automakers, once they do get the specifics of the deal nailed down, do they then have to come out and give financial updates, all of them, about how much it's going to cost them?
I would imagine at some point, yeah, that's going to come out. I mean, there's been a lot of bluster by the automakers saying, like, look, this is threatening the, you know, our existence and our future ability to compete, especially with automakers who are not union and their labor force is not union. So there's been a lot of talk of that. Yeah, I mean, I think we'll see the specific economic impact per automaker as soon as it's available. And it'll be interesting to see that those hard numbers versus sort of what the rhetoric has been up until this point.
And David, I just want to talk to you about Shawn Fain's sort of tactics as well, because it's different how he approaches this. It was designed to be different, and it is different. I mean, you just saw it in that soundbite we played. He aggressively goes after these companies. He's on the news cable shows, making the rounds. What do you just make of those tactics and that strategy? What do you make of the approach, David?
I mean, I think it's working. I think it speaks to sort of the larger frustration UAW members have felt, both with sort of the gains they've gotten and not gotten over the past 15 years. But also, you got to remember, one thing, Shawn Fain was elected on a very slim margin, right? So there's a lot of pressure on him to get a deal across the finish line. This wasn't like this was an overwhelming election for him. But there's also, this is against the backdrop of several years of UAW leadership being indicted on corruption fraud or corruption charges. So there's been some frustration that both the leadership hasn't been working for UAW members, and then also the UAW has also given up too much in previous negotiations. So I think what you're seeing is all of that sort of coming to bear, and Shawn Fain is sort of the tip of the spear. He's the spokesperson for that pent-up frustration.
Yeah, well, we'll see what happens. Maybe a little movement over the weekend. David Underkoffler, thanks for joining us. Appreciate it. Have a great weekend.
Thank you, guys. You too.
It's closing time here at Yahoo Finance. Here's a look at the top stories of the day. Okta, one of the worst performers in the S&P 500 on the day, shares dropping after the company said it had notified customers of a data breach. Okta investigating the incident and taking additional measures to protect its customers. Meanwhile, a dark cloud cast over solar stocks as they get slammed on Wall Street. The move coming after SolarEdge cut guidance and warned that demand is weakening in Europe. The House Speaker saga continuing on Capitol Hill after 3 failed Speaker ballots this week. House Republicans voted to drop Congressman Jim Jordan as their nominee. This move leaving the chamber without a nominee for Speaker for more than 2 weeks.
And here's what to watch next week. All week long, we will get earnings from the biggest names in tech. Microsoft, Amazon, Alphabet, Meta, all expected to show an average 34% year-over-year jump in earnings. They are the biggest companies on the S&P 500, and the hope is that they'll pick up the slack from other sectors as the street expects it to stay generally flat this earnings season. There's a lot of other big names reporting as well outside the tech space. Automaker Ford will report on Thursday. We expect the numbers to reflect the impact of more than a month now of strikes by the UAW and shed more light on its slowing EV production. And snack foods, Hershey and Coca-Cola will report as well. We expect the calls to be full of questions about the rise of the use of weight loss drugs like Ozempic and Wegovy after PepsiCo was not so concerned. On the economic front, we're going to get the latest read on the consumer with the PCE being published on Friday. It will be the last bit of data that will give economists and the Fed indications on the state of the economy ahead of the next rate decision. Wall Street estimates that consumer spending will outpace income growth again, but at a slightly slower pace than the previous month.
All right, that'll do it for today's Yahoo Finance Live. We, of course, will be back on Monday morning. Maybe we'll have some news on the auto front.
Maybe.
Unclear.
Yeah, not only Fed speak now. You can actually move from Fed speak. You have real earnings to look
Yeah,
over.
there won't be any more Fed speak, actually, because they're in the blackout period now. But, without that guidance, what is going to happen in the bond market? I think that's going to be a big question going into next week as well. So tech earnings, bond prices, we'll be here to take you through it all. Have a great weekend, everybody.